Hey everybody, it's Pete. Good morning. It is Friday morning, March 13th, my brother's birthday today. Happy birthday, Tom. Today we're going to discuss stacking the odds in your favor, working your way down from trading the market to trading a sector or an industry, down to trading your stock, and how that will affect your conviction level in your trading opportunities. And it really comes down to how much money is all on the same side of the trade, and how that should affect the share size, how many positions you have, as well as how long you hold the trade. Today we got some good news overnight. The stock futures, the ES futures, E-mini S&P futures have actually rallied back and completely wiped out yesterday's losses. So we're actually going to have some opportunity to be looking for some longs today. We're going to look at as many individual stocks as possible. After I do a very quick lesson on setting up from top down to bottom down. So if you want to write down the terminology, we're going to discuss top-down analysis and how it'll affect your trade management. If you enjoyed today's video, please click subscribe. I got to practice that. Please click subscribe to make sure you get updates. So looks like we're going to actually have a decent day to trade today on the long side, but we're going to make sure that we set up some opportunities where you're always managing your risk. Again, you do not want to be buying on the way down in this kind of market right now. You want to wait for some sort of short-term proof in the market. And it could be as simple as 2 candlesticks so that you have a little bit of movement in your favor, as well as you have a really clear stop loss point if prices should happen to turn around to the downside. So we're going to go to the charts. We're going to take a look at where the futures are right now and why I believe that today we're going to have some opportunity to get long and actually feel confident about that. And by the way, if you're not sure some of the terminology that I discussed, like talking about getting long, getting short, hitting the bid, well offered, I'm actually going to be doing a podcast on that soon. So I'll post a link and I'll let you know in a future video about that, because it's kind of important to know the terminology. So we're going to go over to the charts now, and we're going to get right into it. So you can see here what's going on with the futures overnight. We are actually all the way back to where the Fed made the announcement yesterday about pumping more money into the market. That's basically what's going on here. The Fed vows to pump trillions more into the market. That announcement actually came during the day. That was right here, and it really didn't make that much of a impact other than that one bounce to the upside. And you can see we actually flushed all the way down. Now, one thing that I really can't stand is when somebody which is kind of common, I guess, says this is what I would have done yesterday, type of deal. I hate that. I show some guts and say what you're going to do tomorrow or what you're going to do this afternoon. And that's really my job. The better job that I do helping you guys set up if-then scenarios, which I hope I'm really drilling that into you. You'll be making your own way in the market. You won't be looking for somebody else to give you money. You'll be saying, if this happens, because of all these reasons, then I'm going to do this, and I'm really confident about that decision. And I'm excited when I get emails and comments that at least I'm helping to give you some structure, which is really important, because if you think about any other job that you have, it's super exciting when you go in and saying, I have control over the outcome. Isn't that why we're doing this in the first place? We're doing this because we want to achieve some sort of control over our financial freedom. And the more you understand what you're doing and the more distinctions you could make, and you make that leap from chart reader to tape reader, you actually start to control your revenue. And yeah, it is revenue. We're running a trading business, right? So obviously the big thing in the market here today that we're going to be watching for is we're all the way back up to these levels when that announcement was made. So above this level, which looks like 2580 here in the ES, and then we're going to go over to the SPY, which is basically the same number. So we're going to actually pull this line down here. And the reason I'm using this one is because we spiked up, it came all the way back down. So we're basically looking at 260 in the SPY. That's the level that we would need to actually get excited about, which is essentially yesterday's high. So we have a choice now heading into today. We could trade while we are inside of yesterday's price action, which is right here. Now again, this last move to the downside, this is actually a pretty good lesson here as well. Yes, that's yesterday's low, not even a question. but the majority of yesterday's trading occurred here within this window. This window of what's the close here? Let's call it 251.22 to 261.94. So let's say 262. So basically a 10-point trading range here, 11-point trading range. To me, that's where most of the price at. Like this one blip and this one blip, yes, it definitely closed on the lows. I'm not saying it didn't. However, as we've discussed in the past, we want to find out where most, and I use this analogy from that book, Tape Reading and Market Tactics by Humphrey B. Neal. I've talked about it before. It was written way back in the day, but it gives you a really good mental picture of saying how many jackets actually sold at that price, where he says that the market is no different than a tailor selling jackets. And if you just say that, the high of the day was we sold jackets at $20, but you sold one, versus you sold 500 jackets at 1950. 1950 is the real level that you should be paying attention to. So I'm not saying not to be aware of these, like this high all the way up here and this low down here. I'm not saying not to be aware of it, but I'm looking at where most of the jackets were sold, and that was in here. So I'm really focused on two things right now. If the market does, even though the SPY is negative, it does appear that we're going to open higher. So we're going to open up within this window. So again, as we had said a few days ago, I'm not necessarily going to be looking to buy the open immediately if we do get a move much higher. What I am going to be doing is to be looking to bid the first pullback on what is either a swing low or well bid candlesticks, which in certain instances, they could be exactly the same thing. So if you don't understand what a swing low is, I am actually going to find one for you right now, which ironically could actually be pretty hard to find. I'm gonna remove the moving averages here, and this is a swing low. So this is actually what we're looking for right now. A swing low is where you have a low and then higher lows on each side. So essentially what you have is you have it going down, going down, going down, going down, and then one candle pushes lower and the next candle makes a higher low. Now, that's a swing low. That's the first situation where you could potentially look for a spot to buy if the market opens higher today and pulls back a little bit. Now, you could look on multiple time frames. You could look on the 5, you could look on the 15. Those are primarily the time frames that I look on. I don't go lower than that time frame. I used to when back in the day when things were in fractions, and I generally don't look lower than a 5-minute chart. The only time I do, actually, some people will ask me that question. The only time I do is when we're kind of like a rocket ship and I just can't find an entry in something that's really obvious. I might drop down a little bit lower to try and spot an entry on that time frame. And the other one, so swing low is this here. We get the low and higher lows on each side, but you'll notice this candle here is actually an inside candlestick. So that is technically a signal in itself, an inside candlestick breakout. But what's a little bit more significant is when you get something that's well bid. And I'm going to boost this out a little bit here again. So well bid means a higher high and a higher low. So institutions, the smart money, are actually holding higher lows and creating higher highs. So if we get that, that will be an area in price action that I'll be looking to start to look for a bid. So today, you can see the exact reason why I'm not looking to be chasing price, but I am looking for levels today to get long, because the news was actually, coronavirus news was not positive. The financial news of the government stepping in to help is going to be a big deal. I'm actually going to make a video a little bit later that I'm going to predict what's going to happen next and how I'm setting up my game plan over the next 3 to 6 months. And I think you might find that interesting. So getting into the news a little bit, you can see here the Dow futures, and we just saw the S&P futures are pumping a monster move to the upside. Then we also have an interesting story here in Market Watch. The Dow is at risk of the worst week ever in the history of Wall Street. Let's hope that doesn't happen today. We are getting that spike to the upside. Again, nobody can predict what's going to happen, but that's a pretty interesting story to be living through. If you traded through the financial crisis or any of those things, you'll know what it means to trade through history. Unfortunately, we prefer not to be trading in a bear market history. So we're gonna briefly touch on the top-down analysis stuff. So, as you know, we're setting up stuff in the way that I look at things on the daily chart. So we're always looking at the higher time frames on the daily chart. So the daily chart starts, generally speaking, you're looking at the monthly charts. Then you break down to the weekly. So let me actually take a step back. So what are you actually looking for? You're looking for long-term trends. You're looking for the trends not to be broken. If you don't want to go all the way back to say, you know, I don't care what happened in 2016. It doesn't matter to me. 100% okay. So let's actually just do it right here for the last few months. So we're going to take a look at the SPY on the monthly charts. So remember what I just said about well bid and well offered? So technically here, the market went well bid in September of 2019. So technically you had well bid, which is higher highs and higher lows on this candlestick. So now you drop down to the weekly and start to see if the weekly is doing the same thing, and the daily where you can start to look for some entries. Then you have well bid followed by what's known as a bullish engulfing candle where the highs and the lows were taken out, but the people on this side were actually caught, right? They got short or sold, and the price rallied back, and you usually get some pretty solid moves after that. So we went well bid, well bid, well bid again. But again, here's something that I talk about all the time, and I know I've harped on this in a recent video, and I get a lot of questions about profit taking. How do I know when to take profits versus how do I know when to hold on to trades? So technically here, from what I just said, this candlestick is technically still well bid, right? Higher highs and higher lows, but you have to start making the difference between closing on the highs, closing on the highs, closing on the highs, closing on the lows. Despite the fact that's a bullish candlestick and it went all the way up here, something different happened. So your spider sense needs to trigger there and say, okay, something different happened where we no longer closed on the highs. We no longer closed above the open for that month. Price action is changing. Move up your trailing stop. Now, here's a big thing. I want to make sure, excuse me, my coffee give me a heartburn. That means move up your trailing stop loss. So if you have profitable trade, you're going to move up your trailing stop loss. That doesn't mean to get short. It doesn't mean you just start trading. I mean, despite the fact what happened, that's not what that means. That's obviously a different scenario. But as stocks start to move in your favor and something different happens, you move up and make a determination. Okay, if stocks get down to this level, I'm going to book some profits or maybe all of the profits because price action changed. So essentially what you're doing, you're reading the tape. You're letting the market teach you when you're supposed to do something. Instead of you saying, well, there's a Fibonacci level and all this other stuff that I've tried in the past. And the only thing that works is price action. Pay attention. Let price tell you where it wants to go. So once you have where you believe the general market is and where it's going and how much room to go you still have, then you work your way down to the individual sectors. And I generally break them down by ETF. If you want, you can take a quick screenshot of this so you can write them all down. To me, these are the major ones that I pay attention to every day. So then I'll take a look on them over the chart. So and I'll just use it as an example for this video. If I feel like the market's in a strong bullish trend and I want to be long, then I'll look to see what sectors are doing the same thing as the market or which ones aren't, quite honestly, so I can look at relative strength and relative weakness if the market turns. So what you would end up doing next is then you would go into the individual sectors and see which stocks are performing. So you're starting with the market, having your bias for the market. Then you go down to the individual sectors. You could look at ETFs if you want, like I do. And then within those ETFs, you look to see which ones have the most volume and are trading well. So it's market, sector, individual stocks. And then here's the key, and I'm going to come back onto the screen for a second there. What you end up doing then is you find the stocks that have the best liquidity and volatility. So as you know, if you're watching the videos every day, to me, that means 2 million shares average traded per day and $1.50 average true range, okay? So then you end up finding there's certain stocks that meet that criteria. You might have a whole bunch of stocks that make up the majority of that ETF, but only certain ones match that criteria. So I'm actually gonna go back to the screen and show you a final scan of what happens. So here's the key that I wanna make, because I mentioned this just slightly before. Once you have your bias of the market, and I'm using the word bias very, very specifically because I don't say an opinion. You don't want to have an opinion on the market, because once you get it in your head, you're like, no, the market's going up or the market's going down. You kind of get locked in an opinion and you tend to try to prove yourself right. You don't want to try and prove yourself right. That's very expensive. And that's where the biggest losses end up coming from. If you have a loss, take it. If you have a good position, manage it, right? So my point is, the more conviction you have from your top-down analysis, where the market, the sector, or the industry, and then the individual stocks, you're stacking the odds in your favor. Absolutely the right way to trade. Now, I got a question the other day that can you only trade on the bottom rung where you're only paying attention to what your market's doing without looking at the sector and, what your stock is doing without looking at the sector and all the way up to the market? You absolutely can do that. And a lot of traders do trade that way. I'm not saying there's anything wrong with that. However, if we want to be awesome, if we want to say, I got it, I built this beautiful argument about why I should be buying this sector of stocks, it just makes sense to do just a little bit extra work and look at everything. Because what ends up happening is all money is flowing into that sector if everything is on the same page, if it's in sync, and a lot of stocks in that sector are all getting buying or selling at the same time. It's often asked, what's the difference between somebody who breaks even and can't get to the next level versus somebody who does really well with consistency? And it comes down to doing that little bit of extra work. It's that little bit of extra 1% that you put in on a daily basis and a weekly basis and a monthly basis and an annual basis. That little bit extra 1% where you say, I'm going to see if I could stack the odds in this position. That's the work that puts you over the top and makes you somebody who pulls money out of the market on a regular basis. So I'm actually going to go back to the screen and I'm going to show you just the last final step in setting those trades up. So once you have your individual stocks, then I actually have different lists you can see here. Let's just go to healthcare, for example, and we'll let that pull up. So 39 stocks meet the criteria. Let me just pull out the criteria again so you can kind of replicate it for yourself. With over 2 million shares. Now I'm going to break this down a little bit further into average true range of $1.50, and that brought down to 29. We're also going to get rid of ETFs or anything like that. We don't want any of those inverse things in here. And we're at 28 still. So these 28 stocks would now be the stocks that meet the criteria for me to go from top down, market, sector, all the way down to the individual stocks. And that's how you end up stacking the odds. So what you normally do is you would take the stocks that you want to watch that day and you put them into your watch list, and those become the stocks in the sector. That's actually a really common way to trade as well. If you've ever heard of like hedge funds and that kind of thing, you know, we're an oil hedge fund, we're a financial hedge fund, that kind of thing. There's upsides and downsides to that. The upside is you know it better than anybody if you do your work. The downside is when those sectors go into a trading range and there's nothing or there's no news, you can kind of get stuck there and not have opportunity. But when there is opportunity, you should clean up because you are hyper prepared for it. So the other way to take a look at this stuff is if you go into this software, and again, I don't get paid for the software, it's free. You can then go into sector performance and find the individual opportunities that you might be looking for. So if you go to overview, it'll give you the large, broad sectors. Then let's say you want to go into financial, you click on financial, and you can see financial brought up everything, right? So that's where we go back into, we're going to click all, we're going to click stocks only. We're going to work our way down to only stocks that have average 2 million shares traded per day. And then the last part of the criteria, we are going to look at stocks that have an average true range of $1.50. So you can see we just took over 3,000 stocks and whittled it all the way down to 50 stocks. If you want to take it even a step further, let's say that we only want to look at stocks over $20, just for argument's sake, just to help you really drill home the point of how to do this, and that brings it down to 48 stocks. So that's how you would work your way down to trading an individual sector, and then ultimately the individual stocks in the industry, all the way down to trading individual stocks. And that's how you then do your relative strength and relative weakness in those stocks. So what we're going to do now is just basically take a quick look on the hourly charts. Actually, I want to jump down to the hourly charts. And we're going to look at some individual stocks. I'm actually going to sort this by alphabetical order. You know what? I'm going to actually sort it by change from yesterday. Which ones actually went down the least? So again, this is actually a good example here in Amazon. A lot of stocks had a gap yesterday, so a couple of days ago, price action is really not going to matter that much. However, I do want to talk about something that I mentioned maybe earlier in the week, maybe like Tuesday, which was using the 50% retracement level as a target or a place to enter. So what we're going to look at is Amazon all the way up here to down here. You would calculate, oh, I'm going to sneeze, the fan is on. Excuse me. All the way up here where the high was 1894.27 and the low was down here at 1674. So let's just, for argument's sake, if that is $200, just for the sake of this conversation, you would take half of $200 and you would have whatever that halfway mark is. That would be your initial profit target for today. So again, that's how you calculate if we end up bouncing today, holding the bid. Again, terminology, holding the bid means smart money's holding it, and we start to get places and we start to get some rallying. Obviously, this level here, where a lot of those quote unquote jackets were sold, right, would be the first target where we would expect some resistance. And then whatever that 50% level was, that would be where you would end up looking to be your initial target on an aggressive trade on the long side today. So if we did the same thing here in the SPY, let's actually just calculate that. There is software to do it. I generally don't. I think you can use Fibonacci retracements. But let's just use the SPY here as an example where it was 288.51. And we're going to use over here 252. So roughly $36. And that would be $18 off of the low. And whatever the exact calculation is, my coffee hasn't kicked in yet. Let's say 288.50 and 249.50. So basically, let's just say it's $20 off the low. We would move this up to 269, roughly right there, just for illustrative purposes. That would be the ultimate target, our initial target, excuse me. That would be our initial target to be looking to moving up our trailing stop because it's halfway back from here all the way down to here on the hourly chart. So you can actually run through your individual stocks that you normally watch. Take a look to see if you have anything that's going to be well offered. Look for the real buying or selling occurred yesterday. Don't use that one print all the way up there that looks like, oh gosh, that's the high of the day, when 100 shares might have traded there. You can actually get in there and see where did the most volume trade. You can generally see that on the candlesticks. We also covered the top-down analysis today. That'll help put some stuff into your stock watch where you could very easily, and I'll just use the semiconductors, for example, where you would have the market. Let's say you'd have the Qs, then you would have the SOX index or whichever ETF you want to watch, SMH or the SOX, one of the two, and then all the individual stocks that have the majority of the volume in that particular industry. And that would be your stock watch. You'd literally be looking at it and say, okay, well, two out of 5 of them are long, 3 of the 5 are short. So if the ETF is strong and the market's strong, then you trade only those 2 that are strong. If they're all strong, you could then get a little bit more aggressive where you might have more shares, more positions, and hold those trades longer. So again, trading a little bit more aggressively by having all those parameters, meaning more shares, more size, and more shares, hold longer, and more positions, because you have all that money flowing in at the same time. So I hope that was a good illustration of how to prepare for today, and then ultimately how to put some stuff into your stock watch for purposes of a quick scan. Because I get that question all the time. How do I know? How do you look at so much stuff at the same time? Well, that's how you prepare before the market opens. And then you say, that's the only stuff I'm looking at today. If this happens, then I'm doing this. So let's actually finish up on a strong note of what that means. Without even looking at the charts, if you sort your stock watch by change from the open and change from the close, that means you'll have red or green from yesterday's close, and you'll have red or green from today's open. Something as simple as, if both of those are green or both of those are red, that means that they're doing the same thing from yesterday and today. And then when you throw moving averages and trend lines on top of that, you keep stacking the odds of good trades, right? I'm Pete Renzulli. Hope you enjoyed today's video. If you enjoyed it, please click down and subscribe. And have an awesome day today. Have a great weekend. I will speak to you again on Monday. Have a good day today, everybody.